Hey, what's up, guys? Have you ever wondered how land flips are taxed? Or perhaps you found yourself wondering which business entity holds the key to unlocking maximum profits while minimizing tax liabilities? Well, in this video, we're going to be diving headfirst into the intricate world of land flipping, from understanding the tax implications to strategically choosing the right entity to help you up your game. All right, let's get started. Okay, so when it comes to land flipping, it's really not that much different than flipping real estate. They're the same things that a tax court is going to look at when it comes to taxing your entity. And of course, that's the most important thing. What type of entity should you be setting up? Should it be a corporation, limited liability company? Because those are the things that can really help drive your profit or minimize your profit, because you're going to get slammed with taxes. So before I get into showing you the right types of structures to set up for your land flipping business, whether or not it's an LLC or a corporation, I first want to describe to you what the difference is, what that actually means, what the court is going to look at to determine whether or not the land you're actually flipping is considered to be investment property, which would be taxed at a lower rate, or it's considered what we refer to as dealer property. That means you're holding it as inventory in the ordinary course of your flipping business. And really, it breaks down to a 5-factor test what the courts look at. First, you want to look at the nature of the acquisition. I mean, did you originally acquire the land for investment or development purposes? And so how do they determine whether or not you acquired the land for investment or development or flipping purposes? Well, they're going to look at your intent, the things that you do after you buy the property. For example, if you buy the land and you just sit on it and you don't do anything, well, that's going to lean more towards investment purposes. But if you're out there trying to either figure out how you can maximize its use, you're bringing in professionals or experts to do studies on the property, maybe you're subdividing the land, well, that's going to lead towards development side, which has negative tax ramifications for you. Or if you're flipping property, they'll look to see whether or not you are listing the property for sale immediately, or maybe you don't list this property for sale, but you're exploring possible buyers for your land. So the next thing they're going to look at, number 2, is whether or not you have a lot of sales. So they look at the frequency and continuity of your business and your property sales to determine whether or not your business is truly about land flipping, or maybe you're just an investor. Again, I hit on this at the very beginning, and why I brought that up is because when you're an investor, you can take advantage of long-term capital gains rates. If you hold it for more than a year, or if you hold it for less than a year, it'll be short-term capital gains rates, but you're not going to get hit with employment taxes if you're considered to be a dealer in land. So the third test, or the third prong the courts will look at, is they're going to look at the nature and the extent of your business, all right? What types of actions were you taking to increase the land's value? You know, an investor, when you buy land, what you're going to do is you're going to hold on to it and let the markets decide whether or not that property is going to go up in value. But if you buy land, and again, as I stated earlier, you do things to increase its overall value, then you're going to look more like a dealer. Again, I'm going to tell you what you need to do, or I'm going to show you from an entity standpoint here in a minute how you can handle both types of situations, because you can be both a dealer and an investor. You just have to use different entities for those different types of business activity. So the fourth test is going to be to examine the level of your involvement when selling the property. All right, did you spend a significant amount of time finding buyers and negotiating the property sales? Now, you may think, well, if I'm going to sell property, that's what I'm going to do anyways. But there is a certain level here that they're going to evaluate and say, well, this is really more looking like business activity and not that of a investor. Okay, the fifth and final factor they're going to look at is they're going to evaluate the extent and substantiality of the sale transaction. I mean, were there any red flags that indicate the sale may not have been at arm's length, or the price may not have been at market value? Now, that really comes into one of the types of structures you can put in place when you're developing land that I'm about to show you, because these are things you have to understand. If you're in there to buy land and make a profit from your land purchases, you want to make sure you're structuring it right. Hence the term LLC versus S corporation, which is the best structure for you. Heck, it might even be a C corporation. All right, so let's talk about the various structures and what we're going to be looking at if you're getting involved in land flipping. So the things that I'm going to tell people, if you're going to go out and you're going to flip or develop property, it's a different type of test. So if you're just flipping land, all right, so if I'm just going to flip land, then what I'm looking to do is I'm going to create just a corporation here. I'm going to set up a corp. Now, this could be an LLC taxed as either a C or an S corporation. So what's the difference? Does it matter? It really does matter if it's a C or an S corporation, because a C corporation is taxed at a flat 21%. That means every property that you flip, let's say I buy a piece of property here and I sell it, then if it's a C corporation, if I made $60,000 on the sale of that flip, then that's going to be taxed at a flat 21% in a C corporation. Now, I really like C corporations for certain taxpayers because depending on your personal tax bracket and whether or not you want to have more money left over after taxes to reinvest into your business, a C corporation can make a lot of sense for you. But if you're one of those who needs the income you're generating from your land flipping business, then in that case, it's probably better to explore using an S corporation, because an S corporation is going to allow you then, if you had this set up as an S and we made $60,000, I can pay myself, let's say, a $20,000 salary and then take the remaining portion out, the 40K, as a distribution. Now, because this is a business activity, remember I talked about employment taxes. This is why you do not want to flip land in your own name, nor do you want to flip land through an LLC that's treated as a disregarded entity or a partnership. You should be paying attention to this because this is really important. I run into people all the time that make this mistake. That when you're flipping land as a disregarded entity or a partnership, you're treated as a sole proprietor. So it's either an S Corp or a C Corp. And if you need the income, then look at using an S, because that $40,000 you take out, this portion right here, is not subject to employment taxes. So for most land flippers, what we're going to be using is an entity, either an Inc. or an LLC, taxed as either an S or C corporation. And really, that's why you should be clicking on the show link below, or in the notes below. I have a link to set up a strategy session. You can set that strategy session up with us, and we can help you determine whether or not, if you're a land flipper, it makes more sense to be an S Corp or a C Corp for that business. Now, when I'm saying land flipping, what I'm referring to is that you're going to go out, you're going to buy land, and then you're going to turn around and try to sell it. That's what a land flipper is. You're buying the property, you're turning around and selling it. You're not developing the property. A developer is going to be someone that's a little different, and I'm going to show you what a structure would look like for them. Now, the other thing you can throw in here on these land flips, if you want, depending on where you're buying the property, if you're ever concerned that there may be environmental contamination with the property, or if you think you're going to hold on to it for a while and that property may have an issue with people who are trespassing on it. I mean, these are real concerns you have. Let's say you're buying property where people hunt. Then in that situation, you might be better served to set up an LLC that's owned 100% by your entity. So let me just show you what I'm referring to here. So you buy the property, you'll hold title to the property in this LLC, but for tax purposes, this LLC is set up so it does not have to file a tax return. So your corporation, remember S or C down here, owns 100% of this LLC. So in this case, you either flip the land out of the LLC, or you could just flip the LLC to the third party. And, you know, I work with a lot of investors when I'm flipping properties, and I've found out that my investors prefer to buy the LLC rather than the property itself because it keeps their name off of title. So that's something else you might want to explore when you're flipping property, using LLCs for these purchases if you find it's warranted. And the best part about this, if something did go wrong, the LLC is going to protect your business because the liability stays contained right up there. All right, now let's talk about the development side. Okay, so if you want to develop land, now that's a different type of structure than it would be in the flipping side, because now what we're trying to do if we're going to develop, we want to be able to preserve a certain tax attributes associated with that property. Namely being this, that when you start developing land, you move from an investor status into a business status, which again changes the character of the taxation on the sale of that property. Just like the flipper, you run into that issue where, hey, when you're selling the land, it's going to be taxed as ordinary income. And if you did it in your own name, you have employment taxes on that because it's considered to be inventory. So if I was going to buy land with the purposes or with the thought process that I may develop it in the future, what I want to do is make sure that I can keep that property I'm buying at a long-term capital gains rate, down there taxed at 20%, and not moving up into those ordinary income tax brackets. Now, to do this, you have to be very careful on how you structure the overall transaction. If I was going to buy land, I would start off by this. I would set up a Wyoming LLC right here, and I would buy the property in the name of the Wyoming LLC. Now, it does not matter if this land is located in Texas, Oklahoma, Ohio. It's irrelevant here because you may be wondering, well, wait a minute, what happens if that land is located in Oregon? How do I buy it through Wyoming LLC? Doesn't that LLC have to be organized in Oregon? No, it doesn't. Because in this case with land, it's not generating any income for you. So you don't have to foreign file this entity in the other state. Just set up the Wyoming LLC. It's going to give you the anonymity. Makes it really simple. Now you hold it in that LLC and you're not going to do anything with it. So most developers, I've been working with a developer right now. They're going to do this ground up development and they're splitting it off into different parcels so they could sell some to other developers to build housing projects on. And they're going to build multi-units on a portion of the property. They're also going to do some single-family homes. So they have this whole master plan in their head that they want to do with this particular piece of property. Now, here's what I said to them. I said, if you're going to do that and you're going to develop that land, then I want you to hold off on going through any of that process right now when you're considering doing this or writing anything down that if you get audited, somebody can come back to you later and say, hey, you started that development process on day one, even though you didn't break ground on anything for over a year and a half. So you got to be careful on what you're putting down on paper because that could come back to bite you. Because we want to keep this land sale at a flat 20% when we sell it. We don't want it to be ordinary income. So that's key. And I'll give you some factors here in a little bit about how you can protect yourself when you're developing property or flipping property, the things you should be doing that I think are really essential to make sure that you fall more on that side of investor and not on the side of developer or an active business. So you buy that property in the LLC and you don't do anything with that property. You don't move dirt, you just sit on it and you try to minimize the permitting and things like that. Stay away from that as long as possible because if you hold it for a year, then you fall into that long-term capital gains rate. All right, now I'm ready to do something with it. So now you need to set up a second entity. So now we're going to come over here and we're going to set up another entity over here. This could be an LLC, taxed either as a C or S corporation for federal tax purposes. And again, it goes back to what I stated earlier. Really depends on what you're looking to do with that income. Do you need it? Do you want to take it? Or that's not important for you right now. So now I've got my new company set up. So this is going to be my development company. Now it could be an existing company you already own. It doesn't matter. What I'm looking for here is a company that's treated as an S or a C corporation for federal tax purposes. So once I have that company set up, I'm going to set up a separate LLC, and this LLC is going to be set up in the state where the property is located. So let's assume this property here was located in Oklahoma, and I said you could buy it when you're just holding on to it in a Wyoming LLC. But now when we're going to shift into the development phase, now we're going to start doing stuff with it, selling property. Now you're getting more into the business side, which is going to require a registration. So rather than register your Wyoming LLC in Oklahoma, because we're not going to be selling the LLC, we're actually selling the land, as I'll show you in a moment, just set up a new Oklahoma LLC. So you set this one up in LLC in Oklahoma, owned 100% by your corporation. Now you take this property and you sell it to your LLC, which is owned by your corp, and you do it on an installment note. So let's assume that the value of this land right here was $600,000 when I sell it to the corp. So I sell it to the corp for $600K, or its LLC. It agrees to pay me interest only over time, and maybe in 5 years there's a balloon note where the whole note comes due and payable. So that's how I sell it. The reason why I'm doing that is I'm locking in, in long-term capital gains treatment on that $600K. So this $600K will be taxed at a flat 20% rather than an ordinary income tax rate, right? So this is an essential part of this whole plan right here. So now you sell it to the LLC, and then the LLC is going to do all of the dirt work, all the development, all the permitting, and everything that I talked about earlier that you should stay away from. Now you can go and do that. But by doing it this way, we're going to have any gains. Let's say we take this property, we bought it at 600. That's the corporation's tax basis, and they do all that work, and now they sell it for $2 million after everything is said and done. Well, that $1.4 million gain, the difference between the 2 and the 6, that will be ordinary income to the corp. Now, if you set that up as a C corp, remember that's taxed at a flat 21%, just like your long-term capital gains rate. But you've made sure that at least $600,000 of this deal was taxed at a flat 20%. You see, if you did do this strategy, then the whole $2 million would be taxed at your personal tax bracket if you were buying that through an S corp or in your own name. And so if your personal tax bracket is 37%, essentially you're paying an additional 17% on that $600,000, or basically an extra 100 grand. So you save yourself $100,000 by setting up an additional 2 entities to structure your deal. So with land flipping, I think, or developing, this is a preferred structure. Now, if you're not doing any land flipping, you're just an investor, then again, I just showed you how an investor works. Just set it up in a Wyoming LLC. So what I like to do is when I buy land, I'm going to set up a Wyoming LLC. And oh, by the way, you can have multiple pieces of land in this Wyoming LLC if you don't feel that those pieces of land pose any potential risk exposure to you. Going back again to the type of property you're buying, whether or not people are on that property, could they ride quads on it? Like one of our clients had somebody riding quads on a lot and somebody was injured and they sued them. So maybe it's one LLC, maybe it's multiple LLCs. But the point is, when you're an investor, you hold your land in Wyoming LLCs like this, okay? And then when you're ready to go into the flipping side or the development side, that's when you're going to be running your corp over here. So if I was into land flipping, I would buy everything in Wyoming LLCs. And then when I get ready to flip, I would move the property over here and I would flip it, right? And whatever I don't flip, I'm going to keep here on the Wyoming LLC side. So I'm drawing a line between the two structures. So if I got audited, the IRS wouldn't look at me and say, hey, everything you're doing is dealer activity. That's your business. No. I have dealer activity on this side, and then I have investor activity over here. So I think that's really important when it comes to land flipping. Now, what are some of the things that you can do to make sure that you can keep this investor status separate on your land purchases? Some of the steps you should be taking with your business. Let's get into that. All right, so number one, what you should look at doing is segregating each property in the books and records. That means keeping really good books and records where you segregate out the property that you're flipping versus the property that you're holding. Now, why do you want to do this? Because it increases the chances that you'll be able to get long-term capital gains treatment on your investment property because of the way you carry it with your books and records. The other thing, which I think is really important, is you want to make sure that you report items as an investment expense. You know, deductions related to a piece of property, such as interest expense, should be reported as investment interest expense and not business interest expense. Classifying expenses as business expenses provides an indication that, you know, you're holding on the property for a business purpose. And I know it can be something that most people, you know, if you have some expenses related to your land, going out and looking at it, you want to be able to write everything off and claim it as a business deduction. But if you want to thread that needle and say, hey, I want to be able to make sure that if I'm holding on to a piece of property, that if I hold it for more than a year, it will be classified as long-term capital gains when the property is sold, then you need to be careful about how you're preparing your tax returns and the deductions, the way you're carrying those deductions onto that return. The other thing, when you set up your entity, you need to state the investment purpose in that LLC. State it in the governing documents that, hey, this LLC is set up to invest in land for long-term appreciation. You never want to put in there that you're buying the property to flip, of course, that would just be stupid. So the other thing that you can run into is where you have an LLC that states, you know, all lawful business activity. If you have an LLC and that business clause is in a lot of them, if you set yours up that way, my concern is that if you did get audited and you want to say, no, my intent was to hold this land long term, well, your LLC doesn't state that. It says all lawful business activity. Your intent could just as easily be to flip the property. This is an area that is typically missed by a lot of people who set up LLCs on their own. When I'm looking at different, bigger pockets and different listservs, very few people talk about how important it is to have a business clause that corresponds with the activity. What it's doing is it's showing your intent. And then the last thing I would talk about, and I've already shown you, is to use separate entities. One factor that determines your intent is the frequency of sales. And if you want to avoid dealer status, you want to avoid being classified as a developer, it's always going to be advantageous to hold your land, in my case, as I stated, in a Wyoming LLC. And then when you're ready to do a sale or development, shift it over to the corporation, which can be taxed either as an S or a C corporation. Hey, this was an in-depth video. I hope you got a lot out of it. If you want to learn more about your particular business and how it should be structured, again, go into the show notes and there is a link that you can click on to set up a free strategy session. If you haven't yet subscribed to my channel, well, you know what to do. Smash the like button right now. All right, take care.